Richard Fuscone was everything you'd want to be as a trader and an investor. Fuscone was a Harvard-trained investment banker with more than 2 decades experience in trading and investing. He made so much money that he was named one of the 40 under 40 on Forbes. He became so rich that by the time he hit 40 in the year 2000, he decided it was time to retire. But in the next 8 years that would lead up to the 2008 financial crisis, Fuscone's financial destiny would take a drastic turn. He'd made a series of poor financial decisions, like heavily investing in high-risk assets, building a massive 18,000-square-foot mansion in New York's wealthy Westchester County, with 11 bathrooms, 2 swimming pools, 7 car garages, and another luxury mansion in the exclusive community of Vail, Colorado. When the financial crisis hit, Fuscone's investments collapsed. And by the year 2009, just 9 years after his retirement, he'd lost everything and declared personal bankruptcy. On the other side of this coin was Ronald James Reed. Mr. Reed was everything Richard Fuscone wasn't, and more. He never went to college. As a matter of fact, for 35 years, he was a gas station attendant and a janitor who swept floors at one of those fancy investment banks where Fuscone worked. There was nothing remarkable about Ronald James Reed, at least until he died in 2014. As at the time of his death, he had more than $8 million in the bank. In his will, the former janitor left $2 million to his stepchildren and more than $6 million to his local hospital and library. You're probably scratching your head thinking, how is this possible? How can someone that's highly trained, that knows almost everything there is to know about the markets fail so remarkably, and a novice accumulate so much wealth? But if you think about it, you see paradoxical cases like this all the time. As a matter of fact, this paradox plays out in your own trading and investing. The more strategy you seek out, the more technical analysis you do, the more you look at charts, the more economic news you follow, and all those exciting stuff you do to make yourself feel smart, the more money you lose in the market. And when you do the seemingly simple, mind-numbingly boring stuff, like stick to a single strategy for years, manage your risk like your life depended on it, take those little profits out of the market, while simultaneously cutting your losses sooner, your bank seems to grow. Not the exciting type of growth you see on Instagram, but growth nonetheless. You should have also seen this paradox in your daily life and around money outside of trading. You've probably found that the more you do, the harder it is for you to earn money. And even much harder is retaining the few dollars you've managed to earn. It's like money has its own mind, its own language that you don't quite understand. And this mind, this language, is the psychology of money. The psychology of money simply means your behavior and attitude towards money. These behaviors and attitudes are innate soft skills that everybody exhibits around money. And thankfully, they're skills anyone can sharpen regardless of their background. The author of The Psychology of Money, Morgan Housel, was able to definitely show that mastering these soft skills around money, that is, the psychology of money, the mind-numbingly boring stuffs you don't want to hear about again for the millionth time, are much more important than any education you might have, any technical skill you might learn, and any investment or trading strategy you might deploy in your quest to gain financial freedom. The dichotomy of these boring soft skills and the exciting technical skills was what separated Ronald James Reed and Richard Fuscone. It is what's been stopping you from achieving trading success and becoming a wealthy investor. In this video, you'll learn the key takeaways from Morgan Housel's The Psychology of Money that will help you solidify these soft skills and master the psychological side of money so you can also become a wealthy trader and investor. Takeaway number 1. You're not crazy. Did you know an investment of $10,000 into the S&P 500 index fund back in 1980 would be well over $1 million today? But let's be realistic, most people won't stay the course. Somewhere between Black Monday in '87, the dot-com bubble in 2000, the 2008 meltdown, or the chaos of 2020, they would have panicked and pulled out. Maybe you did too. Because in truth, most of us don't make financial decisions based on logic. We make them based on emotion. And if you're not wealthy yet, that means most of those emotional decisions have been wrong. And you've probably wondered, if these emotional decisions aren't serving me, why do I keep making them over and over again? Well, let me tell you something that will liberate you from this mental torture. You are not crazy. You're just acting in accordance to your money story. Your money story is the experiences you've had with money from the time you've known what money is, till now. And everybody's experience with money is unique. For instance, a generation of people was born when stocks flourished. Some were born in the crypto era. Some have never experienced inflation. Some have never experienced recession. Some have lived through multiple recessions. Some are from wealthy backgrounds. Some from impoverished ones. Some from households where savings is prioritized. Some have watched their parents fail at multiple businesses and investments in real time, and so on. But it's these unique experiences with money that forms our money stories. These stories shape how we understand money, how much of it we spend, how much of it we save, how much of it we invest, what assets we invest in, how much risk we take on, and ultimately, how we react. That is, our behavior when something happens regarding our finances. Our experiences with money are so unique that Morgan Housel placed it at a 100 millionth of 1% chance of having exactly the same money experiences as another person. As traders and investors, there are 3 key lessons to learn here, and they are: 1. It's futile to try and fit your trading and investment strategy to the exact mold of someone else's. Since your money story is different from his, you'll keep hitting a wall. That means you need to figure out who you are, what your unique money story is, and how to protect yourself from yourself if these stories aren't serving you. 2. After identifying these stories, forgive yourself for all the irrational decisions you've made around money. Because you're not alone, and everyone has their own money story. So, you are not crazy. And 3. After identifying these emotional scripts and forgiving yourself, the first way to start mitigating these emotions is to understand risk and luck intimately. This brings us to the next big takeaway from the book. Takeaway number 2: risk and luck. According to Morgan Housel, we have the tendency to downplay the role risk and luck play on financial success or financial ruin. Risk, in this context, is an action you take in the market that leads to a negative outcome, and luck is an action that leads to a positive outcome. But the ultimate question is, what separates these two actions? For instance, Cornelius Vanderbilt, in an attempt to build and expand his railroad through New York, was quoted to have said that in order to do this, he had to break several statutory laws of the state of New York. John Rockefeller was allegedly said to have frequently circumvented the law that a judge called his company no better than a common thief. But these two men were widely successful, so we find these actions admirable and call them revolutionaries, while at the same time, we blame Enron executives for doing the exact same thing, only because they were caught, prosecuted, and tagged as failures. So we can, in a sense, say that Vanderbilt and Rockefeller were lucky, because it's the same risks they took, but they got different outcomes. Hence, today, we tell a different story. You've seen these risk and luck events in your trading, or at least with other traders. A trader bets big on an event, and it pays off. He's a genius. Another trader bets big on an event. He goes bankrupt. He's a fool. You move your stop loss, and price did reverse. You're a genius. On another day, you move your stop loss, and you end up blowing your account. So, what differentiates these risk and luck events? That's the question that financial experts and researchers are yet to find answers to. But no matter the way you slice it, these risk and luck events tend to generate emotional highs and lows. And when we are in these emotional highs and emotional lows, we don't make good decisions in the market. And not only that, we continue to spiral in either direction. So, to mitigate the effects of risk and luck on your trading and finances, you have to learn to adopt proper risk management practices. Since risk events are inevitable, a proper risk management insulates you when it comes to the market. Risk management helps you leave room for error and risk events. Let's say you're using 1% of your bank to trade. You're basically allowing for 100 risk events, those in your control or not, to happen consecutively before you get taken out of the market. This buys you much-needed time in the market. And what does time in the market do for you? It allows Lady Luck to finally shine on you. This brings us to the third big takeaway from the book. Takeaway number 3. Tail events drive everything. Investment firm Correlation Ventures once crunched the numbers on venture capitalists' investments. Out of more than 21,000 venture financings from 2004 to 2014, 65% lost money. 2.5% of investments made 10x to 20x. 1% made more than a 20x return. Only 0.5%, which is about 100 out of the 21,000, returned 50x or more. And it's from these 0.5% that the majority of the industry's returns come from. This 0.5% are what we call tail events, or Lady Luck shining on venture capitalists. Tail events drive everything, and tail events are everywhere. In 2018, only Amazon and Apple drove a combined 14% return of the total S&P 500's returns that year. Amazon's growth is almost entirely due to Prime and Amazon Web Services, which itself are tail events in a company that has experimented with hundreds of products, from the Fire Phone to travel agencies. Apple's growth was driven overwhelmingly by the iPhone, which in the world of tech products is as taily as tails get. And for those working at these companies, Google's hiring acceptance rate is 0.2%. Facebook's is 0.1%. Apple's is about 2%. So the people working on these tail projects that drive tail returns have tail careers. The entire portfolio of the richest trader and investor alive, Warren Buffett, is characterized by tail events. When asked, Warren Buffett said that over his investing career, he had bought over 500 stocks. And of all those stocks, only about 5 to 10 have been the massive success that paid for all the others and given him his returns. You've seen tail events in your trading too. In the course of a week, a month, or a year of trading, there have been those trades that followed your analysis to the T and given you substantial upsides. So, where does your edge lie as a trader when it comes to risks, luck, and tail events? Your edge lies in your ability to withstand the risks, stay in the market long enough to catch the tail events. First, you need to accept that losses are normal and a part of the game. You don't need a high win rate to be successful in the market. You just need to learn how to take losses, so you will have more time in the market to catch the tail events and let them run. In the words of George Soros, it's not whether you're right or wrong that's important, but how much money you make when you're right and how much you lose when you're wrong. You can be wrong more than half the time and still make a fortune. Stay in the market long enough to experience tail events. And also, with time in the market, you get more proficient at spotting these tail events, maximizing them, and cutting your losses shorter. In the words of the legendary Nick Murray, timing the market is a fool's game, whereas time in the market is your greatest natural advantage. And speaking of longevity and time in the market, this brings us to the next big takeaway from The Psychology of Money by Morgan Housel. Takeaway number 4. Getting wealthy versus staying wealthy. Let's say you've done the hard part. You've tamed your emotions. You've experienced your tail events. Lady Luck has smiled on you in the markets, and you've managed to accumulate some wins. Then, this is where the real work begins. because the money you've made will always want to return to the market. You should know that the game you played to get wealthy is entirely different from the game you need to play to stay wealthy. To stay wealthy, you need to take it a step further than risk management. You need to literally become paranoid. In the words of Warren Buffett, don't risk what you have and need for what you don't have and don't need. Just as you need time in the market to let luck and tail events work in your favor, you still need time to let the power of compounding work in your favor. To allow for the power of compounding, you need to maintain optimism for a very long time. And to maintain long-term optimism, you need short-term paranoia. When you start making money from your trades, you will feel the weird urge to give it right back to the market. It is almost like success plays tricks on your discipline. But that's exactly when you need to double down on your risk management and be ruthless about which trades you take. Not every opportunity is worth chasing. In fact, most of them are just shiny distractions. They are clever illusions designed to tempt you into slipping up and losing what you've worked so hard to earn. So remember, getting rich is just the start, but staying rich is the real game. And it takes patience, discipline, and a deep understanding of your own psychology around money. What you've just watched is me scratching the surface of what Morgan Housel's psychology of money is about. Out of 20 key lessons and stories, I've explored just 3. So if you're really serious about mastering the psychology of money, mastering your emotions, and intentional about learning the high-level techniques you can start using to master money, then you need this book. You can listen to the audiobook free by clicking the link in the description of this video. Before you go, why not check out the review of another trading masterpiece, The Best Loser Wins by Tom Hugard. This book tells the story of how the trading legend transformed his mindset to become a top-level trader. This is for any trader struggling with emotions, overtrading, fear, or hesitation. If this video helped you in any way, please drop a like, share it, and drop a comment. Until next time, trade smart, stay sharp, and may the trend be with you.